I may be the most boring guy in private equity, but nothing gets me more excited than what I'm about to share today. I'm going to share with you what I think might be the next darling in the private equity world.
First off, what does private equity look for in a deal or an industry? Before I get into it, my standard disclaimer. All private equity is not the same. My firm operates in a segment that likes quote-unquote boring businesses. Perhaps this is a small segment and perhaps we are all fools, but it is what it is. We aren't talking about tech companies or AI or the types of businesses that influencers discuss. These are the types of businesses that you drive by every day and don't really notice. These are businesses that perhaps make the small parts you rarely pay attention to around your house, in your garage, or at work. They were never on the unicorn path. They are still important and can be a great performing asset. Regardless, the following three factors are important to many private equity groups, or shortened to PEGs. Number 1, stable, predictable cash flows. I talked about how I and others like boring businesses. Well, low but predictable year-over-year growth is very boring, but there is security in low variability. You might not ever have a year that is up 20%, but you also won't have a year that is down 20%. Second, an actionable growth strategy. This might be a strategy to grow organically, via M&A, or both. Stable revenues and earnings are first, but if growth is uncertain or overly risky or costly, it will be harder for a PEG to get excited about the opportunity. Third, higher ratios of free cash flow to revenue. Part of this is related to higher margins, but there are other factors involved as well. The first step is operating margin, how much each dollar of revenue flows to the bottom line. Next is working capital. The quicker your revenue gets converted to cash, the better. The final step is to look at any required cash flows that don't hit the income statement immediately, such as CapEx. CapEx will hit the income statement eventually in the form of depreciation, but not all CapEx will be recaptured in the year in which the cash outflow occurred. If you will accept the position that the 3 points above are important to private equity, then a strong case can be made for private equity interest in the quick service restaurants industry. First off, spending at restaurants is fairly stable. According to the National Restaurant Association, even with the recent choppiness, the overall trajectory of restaurant sales remains generally positive and with a steeper trend line than many other retail sectors. Total eating and drinking place sales increased 6.5% between March 23 and March 24. In comparison, consumer spending in non-restaurant retail sectors rose 3.6% during the last 12 months. Nearly 3 percentage points below the restaurant sales gain. Additionally, sales are expected to reach a record of $1.1 trillion in 2024. The QSR category appeals to the greatest percentage of the population: low income, blue collar, gray collar, and white collar. Why is this? Eating out is a fundamental part of life in the US for many people, especially in this era of a willingness to pay a premium for convenience. According to the same report by the National Restaurant Association, 67% of millennials and 63% of Gen Z adults say ordering takeout from a restaurant is an essential part of their life. But it's not just eating out. The largest chains are the ones that are growing the most. According to Restaurant Business Online and sister company Technomic, the chain restaurant universe has had a considerably stronger recovery than have independents, which struggled more during the pandemic in its inflation-heavy aftermath. As a result, sales generated by the 500 largest restaurant chains now account for 59% of total restaurant industry sales. That's up from 53% in 2019. And the top 500 itself is top-heavy. 43% of the sales generated by the top 500 came from the top 10 largest chains, which together had $170 billion in sales. To put this in perspective, 1/4 of all U.S. restaurant sales came from the following chains: McDonald's, Starbucks, Chick-fil-A, Taco Bell, Wendy's, Dunkin', Burger King, Subway, Domino's, and Chipotle Mexican Grill. Another positive factor for restaurants is the moderate CapEx required. In 2022, total CapEx was estimated to be roughly $30 billion on total industry sales of nearly $1 trillion. That translates to about 3% of sales to be spent on CapEx. What's interesting, though, is that figure represents an all-time high. The third reason that private equity should be interested in QSR is because of the M&A growth potential. Now, if the strategy is to buy boring businesses with stable growth, Organic growth is probably not going to be a major driver. Countering this, there are numerous brands or concepts that are fragmented and would allow for meaningful growth via M&A. Sure, at some point, growth within one system will slow or even stop. If or when that happens, there's the potential to enter into a different brand. Almost all of the largest franchisees have multiple brands. According to Franchise Times' Top 200 ranking, the top 5 largest franchisees average 4.6 brands each. Additionally, this report indicates steady growth from 2018 to 2022 among the top 200 in sales and unit counts. While the large private equity firms are not interested in operating stores, they are in fact interested in franchisors. Rourke Capital announced intentions to purchase Subway in late 2023, and just recently, Blackstone expressed interest in Jersey Mike's. Combined, those deals are worth almost $18 billion. Interest from the largest and most well-known pegs will have a trickle-down effect.
Our goal has always been to prove our chops as operators within one brand and then expand brands, with the ultimate goal being a top 5 franchisee in 3, maybe 4 brands. Now here is where things are going to start to get a little bit unpopular or controversial, or perhaps to use a positive term, exciting. I actually think Subway is a great brand to get into. Now, before you turn off the video or start throwing things at the screen, just keep an open mind as I dive into the reasons why I like Subway, and I think it could be a great fit for many private equity firms in their investment dollars.
I'm proud to present to you the future of Subway sandwiches.
First is scope. No matter which way you slice it, Subway is big. Subway is the largest restaurant chain in the world, second largest franchise chain of any type behind 7-Eleven, and in the US, around 50% more stores than the second largest franchise, McDonald's. In terms of revenues, Subway is much lower on the list at number 8, but that is still very sizable and dwarfs the other sandwich chains such as Jimmy John's. Another reason we like this chain is that it's easy to operate and thus be profitable at lower average unit volumes or AUVs. My team has attended, and thankfully passed, Subway University. Now this team has experience in a wide range of food industries, from coffee to chicken to full service. We knew the operations were simple, but actually being in a store and manning a shift allowed us to see how simple the operations actually are. The simplicity of operations is reflected in CapEx spend. The system average AUV for Subway is approximately $441,000. New ovens cost $5,000 to $10,000. Toaster ovens in that range as well. Refrigeration can be costlier. Then there are the rooftop units that occasionally break down and need to be repaired or replaced. But ovens and refrigeration and HVAC systems last at least 5 years. Some franchisees have been using the same ovens for 10 years. Finally, to remodel a Subway restaurant costs between $40,000 and $60,000, with remodels being due every 7 years according to the Franchise Disclosure Document, or FDD. The point here is that the CapEx required for Subway is much less than the 2 to 3% figure for restaurants as a whole, as should be expected. CapEx is closer to 1% actually. Even though the operations within a store are less complex as compared to other brands, the franchisor makes life simpler still with a robust playbook, as we call it. This playbook consists of best practices, technological tools, support, and various other tools. After all, in 57 years, Subway has learned a lot.
We have talked to many franchisees that bristle at the thought of doing it the quote-unquote Subway way. What's our take? Well, if we thought we could do it better than Subway, we wouldn't get into the system. We would either start our own brand or find another brand to get into. Part of the reason for entering into a franchise system is all the experience, all the brand recognition, all of those things. And if we're not going to take advantage of that, then we're the fools for getting into the system.
Subway is also unique in terms of the number of franchisees within the system. In the US, the average number of stores per franchisee is less than 2. As a consolidator, this represents a huge potential market and one in which there will be several swings of the bat allowed, meaning unlike in other industries, if you miss out on a deal, it is tough to say when you will have another chance. Not the case with Subway, and a very important factor in assessing the likely success of an M&A strategy. More on the current CEO shortly, but in an article published by QSR Magazine, he is reported as saying that he told the families that if they truly want to fix the brand in the US and grow it internationally, industry veterans with scale needed to enter the system. That is just the message the PE likes to hear. Finally, the dynamics within the family and the C-suite are better than they have ever been. After decades of either family and/or family foundations calling the shots, in 2019 it was decided to finally bring in a non-family member as CEO, a guy by the name of John Chidsey. Prior to his hiring, Subway had experienced 6 consecutive years of negative sales growth. Chidsey was tasked with reversing this trend and brought on board executives from McDonald's, Burger King, Outback Steakhouse, Focus Brands, Coffee Bean and Tea Leaf, Pepsi, and Michaels, among others. Together, they have implemented a number of different initiatives. First off, fix the food. There was a period in the 90s and into the 2000s when the sister of the late founder Fred DeLuca ran the business. Trying to build on the reputation for being the healthy option, she made it an imperative to drastically reduce salt in all of the food. The rationale is clear for lower sodium intake, but you can't make bread or cold cuts without salt and expect it to taste good. To improve the food, the brand has introduced new sandwiches, new proteins, new veggies, including an avocado option, and new cheeses, including a fresh mozzarella option. A recent menu addition, introduced in April 2024, is a new lineup of wraps featuring a lavash-style flatbread that has a soft and bubbly texture, which follows the introduction of quote-unquote sidekicks, which are foot-long pretzels, cookies, and churros. What's more, they simplified the menu to allow for ordering by number while also introducing premium ingredients.
If you watch my video on Southwest Airlines, you might recall that I really like it when one part of the strategy or one decision complements or benefits many other parts of the overall strategy. Ordering by number has many benefits. It improves the guest experience. Now they don't have to answer 10, 12, 14 questions and tell them I want 3 olives and 4 pickles or whatever. It streamlines operations for the sandwich artist. It's much easier to make a predetermined sandwich as opposed to, again, ask 14 questions about how it's to be made. It allows for easier digital adoption. And you want to know the last one? It's kind of surprising. The Subway chefs have been able to analyze certain sandwiches made by consumers, and do you know what? It turns out that the chefs don't like the sandwiches that many of the consumers made. I don't want to say the consumers have bad taste, it's just what they would do is they'd say, I like all 5 of these ingredients, let's put them all together, whenever chefs would tell you, those 5 ingredients probably don't make sense going together.
The second component of Chidsey's plan was to update the restaurants. We all probably have recollections of going into a Subway and it being somewhat dark and dingy, or perhaps even feeling a little dirty. No more. There is a new design strategy that is bringing light and life back to the stores. If you haven't been in a store recently, visit one that has been remodeled and see what I mean. And check out the food while you are there. Now, Subway will never be, nor want to be, a gourmet option, but it is fresh with many options, which is what is important to many consumers. The third leg of the strategy, spend the ad budget on, well, advertising.
What? You might be asking yourself, isn't that what's already done? Well, the short answer is no, it's not.
This is entirely legal and disclosed in the Franchise Disclosure Document, or FDD, but the company is not required to spend all of the ad revenue paid by the franchisees on advertising. If they so desired, they could instead drop a portion of that to their own bottom line, which is exactly what they chose to do. Chidsey made the determination that the ad budget was going to be spent on advertising and recruited A-list celebrities and sports figures, such as my own hometown favorite Patrick Mahomes, plus Tom Brady, Steph Curry, Charles Barkley, Derek Jeter, Simone Biles, and many others.
This is a great example of the law of unintended consequences. General managers within the system have reported that it's actually been easier to hire young people for certain positions because they now associate the brand with some of their favorite celebrities or their favorite athletes.
As it relates to his experience, turnarounds are nothing new to John as he turned around another QSR brand, Burger King. Additionally, it was announced in late 2023 that Roark Capital would be buying the franchisor. That was a great development as Roark is the ideal buyer for Subway considering its vast and deep experience in the franchise sector. Fourth is that Subway is relatively early in its digital evolution and adoptions. 2 reasons that Roark must be excited about buying Subway is that Subway is early in this in conjunction with the huge ad budget. What this means is that Subway will now be able to spend advertising dollars more effectively by implementing, in essence, one-to-one marketing via the app. Here is another reason that ordering by number is important, because consumers don't want to answer 14 questions on an app regarding how they want their sandwich made. According to technology partner Capgemini, the results of the digital evolution are already positive. Digital sales have seen double-digit growth from 2021 to 2022 and have tripled since 2019. The refreshed POS is easier for digitally native sandwich artists to navigate. And finally, automated menu updates reduce administration for franchisees. These changes, taken as a whole, are being acknowledged and recognized by experts in the industry. Not only did Subway increase same-store sales for 13 consecutive quarters, the influential trade publication QSR Magazine named Subway its transformational brand of the year.
I fully expect my viewpoint to ruffle some feathers, and others out there will have a very logical and detailed list as to why my ideas are bad or good. There are several counterpoints that I think I at least need to bring up, whether or not you agree with my defense of those or you disagree.
Number one, I hear all these stories about Subway franchisees not being able to make a profit. First off, in a system with almost 40,000 stores globally, there are bound to be operators that perform very well and those that perform, let's say, less well.
Don't judge me on those two guys. This next guy's my protege. He's top of his class, and for his thesis, he made a party sub.
Regardless, there's more to the story here. In order to get that story, it is helpful to understand the development strategy of the brand for the first several decades of its existence. During this period, the goal was development at all costs. To do this, Subway offered a package that required much less upfront capital than the other brands, but went one step further. In order to run a restaurant, you of course need real estate on which to locate your store. While many of the operators that DeLuca was targeting would not have sufficient personal liquidity to satisfy potential landlords. To get around this, Subway, the franchisor, was the actual lessee who then subleased it to the actual operator. Because of this model, you had folks that were essentially buying a job.
I'm fully supportive of the concept of buying a job, but if so, that should be the actual objective and not the consequence of buying a small business or a franchise such as Subway. When I use the term buying a job, what I mean is buying a business with the intention of that job being your primary income. Perhaps you leave a corporate job, decide you want to pursue something entrepreneurial, you need to replace your income, therefore you purchase this business. Nothing wrong with that at all, fully supportive of it. However, what I have seen is that sometimes folks buy a business not with the intention of simply buying a job, it's meant to be an investment, and instead it turns into their full-time job. Buying a job is good if that is the actual objective, not so good when it's an unintended consequence.
There were a few problems with the development at all costs strategy though. First, it led to, at the very least, a perception that the brand had oversaturated the market. More importantly, the restaurants were located in suboptimal locations. Now, everyone knows the adage that the three most important factors in real estate are location, location, location. However, many early franchisees made the decision to obtain a location with the lowest rent because that felt the safest. Because of suboptimal site selection, there are of course a high number of stores that are not profitable or just above break even. When asked about closing stores, the brand made the following statement: "We have spent the past 2 years optimizing our footprint by using a strategic, data-driven approach to ensure restaurants are in the right location, image, and format. This includes opening new locations, with quality remaining a top priority, relocating restaurants to maximize guest traffic, and closing locations when needed." There are several key points there, one of which being that Subway now uses a data-driven approach to site selection. In an article by Reuters, franchise advisor Robert Edwards is quoted as saying, "Continued closings can also hurt public perception."
While I am sure Robert couldn't care less what I think, I completely disagree with his opinion. I think that there's actually negative brand equity being developed whenever you keep stores open that are not performing, that are dark and dingy. If you open new stores or relocate, you're gonna have a buzz, you're gonna have some excitement. That is far better than simply not closing a store because you think that has a negative brand perception. Again, in my opinion.
Second, there are simply too many Subways in the US. Though mentioned above, oversaturation is still a concern to many, despite the fact that sources indicate Subway has closed about 6,000 stores since 2015. Between the beginning of 2020 and 2023, Subway shuttered a net of 3,200 US stores. That lost footprint alone would be among the top 20 biggest quick service chains in America. There is an argument to be made that there aren't too many Subways, just that they are located in suboptimal locations, and that some operators aren't as skilled as others.
At the risk of sounding critical, you might ask why I am in any position to offer any sort of critique on franchisees within the system. I can tell you that between myself and my team, we have visited or evaluated over 1,000 Subway restaurants. We have seen firsthand what the best operators are doing, and because of this, we've been able to determine where there are areas for improvement.
Here is one example of an area in which franchisees could try to learn from the best operators. In talking to the best-in-class operators, they all stressed that increased store hours were a critical factor in driving increased revenues and profitability. It helps increase sales via third-party delivery services as one major reason. However, as an anecdote, let's turn to a very successful Burger King franchisee. He wanted to get all of his stores running 24/7. The most interesting part is that staying open later actually increased sales during the normally scheduled open times as well. To expand on that, normally his stores might close at 10 p.m. Once he started expanding hours, not only did revenue increase during the additional store hours, it also increased during the 2 to 3 hours leading up to the former closing time. In this case, that might have been between the hours of 8 and 10 or 7 and 10. Number 4, there's a history of bad decisions or decisions that benefited the franchisor. Can't argue about this one, at least looking back. The Jared Fogle incident was awful, but so was the $5 footlong promotion. There were also the claims about Subway's bread not actually being bread, and the tuna not being real tuna.
2 customers at Subway say there wasn't tuna in their tuna sandwich, and they are suing the sandwich shop.
However, it is moot in my opinion now that Chinsey is running the show and that Rourke is coming in. The best franchise operators, and Rourke is at the top of that list, know without any doubt that franchisee health is what is most important, not maximizing royalties. Franchisee health means unit-level profitability. That being said, some would point to a recent decision by the brand to introduce slicers as being yet another decision that reduces franchisees' profitability. Some franchisees have argued that sales didn't increase while labor costs did. What hasn't fully been felt yet, though, are the food cost savings. By purchasing unsliced meats, Subway was able to get a higher number of competitive quotes. Once the new protein contracts are in place, food costs as a percentage of sales are expected to go down by about 200 basis points or 2 full percentage points, which will more than make up for any increased labor costs. Another potentially controversial decision is the switch from Coke products to Pepsi. The switch makes sense from a business perspective because now Subway has one supplier for its drinks and snacks, but the reaction from consumers is still a developing story. Number 5. What about this brand or that brand? Of course, there are other brands that might be sexier or more appealing. There are also other boring brands out there that might share some of the similar traits with Subway. But Subway owns the value sandwich space hands down. Further, part of the reason for picking Subway here is that it is a bit contrarian. In 3 to 5 years, it will be easier to determine if now was a good time to get into the brand.
One of the challenges in investing, whether it's public or private equities, real estate, some other asset class, is picking the right time to get in and the right time to get out. Well, it's far too early for me to say when the right time to exit the Subway system would be. Of course, it's not for several years. However, I do feel fairly confident, very confident, that now is the right time to get in.
Number 6, the food sucks. I realize many people might feel this way, but it turns out many more people actually don't. There's been research performed by LRW and Bain. In that, it shows, in blind taste tests, people actually think the food tastes good. In fact, participants were more likely to say they crave food from Subway than Jimmy John's and Potbelly, while only trailing Firehouse and Jersey Mike's by 3 percentage points each. Subway was the clear leader, though, in other categories, such as value, having something for everyone, and being conveniently located. However, this sentiment does lead me into one of the biggest challenges I think Subway faces.
In my humble opinion, the biggest challenge the brand faces right now is that it has to change the hearts and minds of the guests that they've lost over the years. My own personal experience is, 5-6 years ago, I ate at a Subway restaurant and I thought to myself, I'm probably never going to come back to a Subway. It wasn't terrible, it was just completely bland and did not enjoy the experience at all. It was really just eating to get calories in my body to keep me going. However, when I heard about the revamped menu and all the changes that the brand was undergoing, decided to try it again, and really, I think the food's decent. I go there regularly now simply because of all the changes that have been made. And believe me, I am no connoisseur, just ask my sister, but I can appreciate things like freshly sliced meats, fresher vegetables, including an avocado option, and fresh cheeses like mozzarella. I don't know if anyone in the audience remembers or even ever watched the movie Road Trip, but in it, there's a scene in which one of the main characters, Ruben, is asked about the route that they're taking. He says, it's a shortcut. It's supposed to be a challenge. If it were easy, it would just be the way. The same with investing. If investing were easy, we wouldn't develop nicknames for people like the Oracle of Omaha. Personally speaking, I tend to get most excited about investment opportunities when I've been able to develop a level of knowledge about the company or the industry that one, most people don't have, and two, if they did have that knowledge, they would get excited about the opportunity as well. Subway 100% checks those boxes. I've checked it out, you should too. My name is Nick McLean with 4 Pillars Investors. I'm the most boring guy in private equity. And even though I have almost 20 years of experience in private equity, I also have experience in investment banking, consulting. Through those experiences, I've developed an ability to quickly analyze different industries. You might not agree with my analysis, but you need to take a look at what we've done here.